Good afternoon, everyone.
Good afternoon.
Welcome to today's Wiedenbaum Center Forum on the outlook for the U.S. economy and monetary policy, where we are extremely pleased to welcome the Governor of the Federal Reserve Board, Adriana D. Kugler. My name is Andrew Reeves. I'm a professor of political science and the director of the Wiedenbaum Center on the Economy,
I have a
Government,
question.
and Public Policy.
I have a question.
For those in the audience who might not be familiar with the Wiedenbaum Center,
I have a
we're
question.
a research institute that supports social science research here at Washington University. Every year, the center provides hundreds of thousands of dollars in faculty research support, as well as administrative support for grant work. In addition, the center sponsors lots of public affairs programming, like the one we're having this afternoon. All of that is in an effort to serve as a bridge.
I have a question. Sorry, I have a question.
Policymakers.
Question.
Before introducing Governor Kugler, I want to thank the Department of Economics for co-sponsoring this event this afternoon, and also the School of Law for providing us with this space and also some technical support so that we can stream today's event over Zoom. I want to especially thank the people who actually made this visit happen. Thank you to Governor Kugler's team at the Federal Reserve Board, who've been absolutely fantastic to work with. Also, the Wiedenbaum Center, as most of you know, has really terrific and amazing staff. And I'm eternally grateful to Elizabeth Larson and Alana Beam for all of their help, as well as our student workers, including Yasmin Ibrahim, who is here today. Also, thank you to Carissa Ray and Jessica Kane from the Department of Economics, and also Daryl Baker, who's providing our tech support for us today. Let's give this fantastic staff a round of applause. When you arrived, all of you should have received a note card and a pen. These are for you to write down any questions that you might have for the governor, which we'll hopefully get to during our Q&A. As she concludes her prepared remarks, we'll collect those. So we'll ask you to all turn your note cards into the rows and we'll grab them for the Q&A. And now let me go ahead and introduce our esteemed guest of honor. Dr. Adriana D. Kugler took office as a member of the Board of Governors of the Federal Reserve System on September 13th, 2023, to fill an unexpired term ending January 31st, 2026. Prior to her appointment at the board, Dr. Kugler served as the U.S. Executive Director at the World Bank Group. She's on leave from Georgetown University, where she is a professor of public policy and economics and was vice provost for faculty. Previously, she served as chief economist at the U.S. Department of Labor from 2011 to 2013. Dr. Kugler was also a research associate at the National Bureau of Economic Research and the Center for the Study of Poverty and Inequality at Stanford. Dr. Kugler's other professional appointments include being the elected chair of the Business and Economic Statistics section of the American Statistical Association. She was also a member of the Board on Science, Technology, and Economic Policy of the National Academies of Sciences and served on the Technical Advisory Committee of the Bureau of Labor Statistics. Dr. Kugler received her BA in Economics and Political Science from McGill University and a PhD in Economics from University of California, Berkeley. Please join me in welcoming Governor Adriana Kugler.
Well, thank you, Andrew, for that very generous introduction. And thank you for the opportunity to speak here today. I am very pleased to be talking at this event sponsored by the Wiedenbaum Center, the Economics Department, and the Law School. As an economist currently working on policy, but with a long trajectory in research, I really appreciate the Wiedenbaum Center's multidisciplinary approach to building bridges between these two applications of economics. The Federal Open Markets Committee, or FOMC, has been working to lower inflation in the context of our dual mandate of maximum employment and stable prices. Today, I will discuss economic developments in the US in light of recent data, but also in light of longer-term trends. Since I am an economist, you will not be surprised that I will talk about recent economic developments by highlighting the dynamics of supply and demand. As you all know, inflation began to rise in 2021. By mid-2022, 12-month inflation based on the Personal Consumption Expenditures, or PCE price index, was around 7%, much too high and far above the FOMC's 2% longer run objective. But since that time, PCE inflation has slowed significantly, declining to 5.4% by the end of 2022, then to 2.6% at the end of 2023, and then to 2.5% in February. Inflation can sometimes be hard to read from overall PCE, as inflation figures that come from total PCE are volatile because food and energy prices move a lot. For that reason, it is sometimes helpful to focus on what we call core PCE inflation, which excludes precisely these categories and is a better guide to the direction of inflation overall. Core PCE inflation peaked at a rate of 5.5% in early 22, but also fell rapidly during 2023. And now core PCE disinflation, we know, declined at the fastest rate since the 1980s in the last year. The progress has sometimes been bumpy from month to month. So if you look at January, February data, we have actually seen some firming in the inflation data. But the January numbers in particular tend to be noisy and atypical due to seasonal factors that suggest a need to withhold judgment, at least for the time being. The 12-month core PCE rate now stands at 2.8%. That rate represents considerable progress, but it is still meaningfully above the FOMC's 2% target. I like to think about core PCE inflation in terms of three components: goods, housing services, and non-housing services. 12-month inflation for core goods actually peaked first. It reached a 7.5% in early 2022. But goods inflation cooled fairly quickly. And in February of this year, goods prices were actually nearly 0.5 percentage point below their level just a year ago. Services inflation peaked later, but also has cooled more slowly. Within services, housing services inflation, which measures the cost of rent and the equivalent for owner-occupied housing, rose all the way up to 8% early last year, but is now at 5.8% in February. To be sure, housing services inflation is naturally persistent. And it is persistent because tenant rents often have year-long lease agreements, and estimates of owner-occupied housing costs are imputed in large part based on those same tenant rents. So what we know actually from new tenant rents suggests that housing inflation will broadly continue to cool. Finally, inflation in core non-housing services hovered between 4.5% and 5.5% from mid-2021 through mid-2023, but began to cool after that and now have reached 3.3% in February. Continued disinflation will indeed require progress in both housing and non-housing services. The rise and subsequent easing of inflation in recent years were related to both supply and demand factors. This development has been confirmed by granular bottom-up statistical research looking at price and quantity changes within very narrow product categories. Roughly speaking, if a price goes up while quantity goes down, that is an indication that a negative supply shock is dominating. On the other hand, if price and quantity move in the same direction, that is an indication that a demand shock is dominating. Research using exactly this method finds that demand shocks accounted for 2/3 of the 2021 pickup and 2023 slowing of core PC inflation, with the remaining 1/3 related to supply. The role of supply is even larger or closer to 50% in an hour analysis focused on the domestic manufacturing sector. Top-down research looking at aggregate time series data also finds significant contributions for both supply and demand. Both have mattered during this time period when inflation went up and then when inflation came down again. Let me be a bit more specific and more concrete about this point by discussing supply and demand for goods and services in turn. Supply in some goods producing industries, like motor vehicles, was held down for some time by pandemic-related plant shutdowns, shortages, and also transportation bottlenecks. And demand for goods surged during the pandemic when, as you remember, consumers shied away from in-person services. Businesses frequently highlighted shortages of materials as having held down production during the period when supply was very tight and demand was very strong. Those pressures have eased considerably indeed, though perhaps not completely. Supply chains and productions has largely recovered, and there are signs that goods demand growth since then has eased. For example, the share of consumer spending devoted to goods rather than services has moved back. And it's now much, much closer to pre-pandemic trends after rising sharply in 2020. Regarding services, particularly non-housing services, the most important input to services production tends to be labor. For that reason, it is useful to talk about supply and demand for labor as well. Labor supply was held down significantly in the early stages of the pandemic as workers voluntarily, but also sometimes involuntarily, had to stay away from the workforce. Older workers, if you remember, left the labor force in a wave of early retirements. And tragically, COVID-19 caused a rise in mortality as well. Additionally, many prime age workers, those between 25 and 54 years of age, stayed out of the labor force also for a time, perhaps because of health concerns, but also because of family care challenges and responsibilities. And immigration was relatively low during the pandemic as well. But labor supply has been recovering. While most older individuals have not as a whole returned to the labor force, many prime age workers have. Prime age women in particular have significantly increased their labor force participation, which reached an all-time high last year, and it still remains very close to that all-time high. Moreover, the Congressional Budget Office, or CBO, estimates that net immigration increased by 2.5 million in 2022 and 3.5 million in 2023. If the CBO analysis is correct, population growth has been a sizable contributor to overall labor force growth. A more subtle source of labor supply growth has been improved quality of matches between workers and firms. How well suited particular workers can be in terms of talent, experience, and preferences to their employers. In the wake and until the end of the pandemic, we saw a heightened pace of workers quitting their jobs and finding new ones, a process that economists generally believe improves these matches. Indeed, evidence suggests workers and firms have been fairly efficient in finding each other over the past couple of years in the labor market. High-quality job matches act like additional labor supply. Both firms and workers are likely to be more productive when workers' skills and preferences are a good match to their employer's needs. On the demand side, labor demand was strong in 2021 and 2022. In fact, demand was so strong that the job openings rate, that is the monthly number of job openings relative to total employment, ran almost 50% above its pre-pandemic record all the way from July 2021 through July 2022. But the job openings rate has declined roughly 30% since then, a sign that labor demand, while still robust, has cooled significantly. So the labor market has moved into much better balance, lower demand and higher supply. Importantly, given the strong labor supply growth, supply-demand imbalances can continue to ease, even amid a solid pace of net job growth. Indeed, I suspect a strong population growth helps to resolve the puzzle that forecasters have faced over the past year, in which measures of labor market growth and consumption growth have been solid, even amid easing inflation. As labor markets have moved into better balance, wage growth has also cooled, which means that increases in the main cost of businesses in the services sector have slowed, easing inflationary pressures as well. Workers and families do not reap the benefits of higher wages if those gains are actually eaten up by inflation. It is for this reason that it is important that wage growth be consistent with 2% inflation over time. The US economy is actually moving back towards that kind of wage growth, including in the services industries. The 12-month growth of average hourly earnings in private services has come down to about 4% from a peak pace above 6% in early 2022. And despite the cooling of wage growth with inflation easing over the past year, we have seen real wage gains for all workers in the recent past. But you may ask, what role has the FOMC played in all of this? Well, while supply conditions are beyond the control of monetary policy makers, the FOMC can influence the pace of inflation by tightening monetary policy to slow the growth of aggregate demand. The FOMC began raising its policy interest rate in early 2022 and proceeded expeditiously. These actions have damped aggregate demand, with the most pronounced effects on interest rate-sensitive sectors. For example, in 2023, the level of residential investment was about 19% below its 2021 level, reflecting a much lower pace of home purchases. And business investment in machines has had somewhat tepid growth too, even contracting a bit last year, though I do note that construction of new factories has been surging, perhaps partly related to recent legislation, which will boost supply over the longer term. More broadly, financial conditions have been a drag on aggregate demand, as suggested by the Federal Reserve Board's FCIG, or Financial Conditions Impulse on Growth Index, which estimates the overall effect on gross domestic product of changes in financial conditions, including interest rates, asset prices, and exchange rates, among others. This measure moved well into restrictive territory in mid-2022 and remained quite restrictive for some time, but has become less restrictive more recently. In addition to the direct actions taken to tighten monetary policy, the FOMC has also helped cool inflation through its communications with the public. In particular, the FOMC's stated commitment to bring inflation back to 2%, coupled with its actions to tighten policy, has helped ensure the longer-term inflation expectations remain well anchored. Anchored expectations are evident in surveys of consumers conducted by the University of Michigan and the New York Fed. Separately, a Richmond Fed survey shows a close relationship between firms' expectations of overall inflation and their own price-setting decisions. As the effects of earlier supply and demand shocks fade, firms with anchored expectations will bring their price-setting decisions back into alignment with our FOMC inflation target. One way they might do so is by adjusting prices less frequently. Before the pandemic, the typical price lasted about 10 months. But early in 2022, it was lasting fewer than 5 months. That means these companies were adjusting prices very, very frequently. Since then, the frequency of price adjustments has slowed down considerably again. And by the fourth quarter of last year, the typical price was lasting more than 7 months, so closer to the pre-pandemic frequency. Let me now turn to the outlook for this year. Given my thinking about the role of supply and demand in recent inflation dynamics, as well as the role that anchored inflation expectations are playing in bringing price-setting behavior back to normal, I expect the disinflationary trend to continue. There is still a bit of room for further supply improvements, especially in the services sector, where solid labor supply growth will continue to ease wage and inflation pressures. On the demand side, I expect consumption growth to slow some this year, as households have drawn down their balances of excess savings accumulated during the pandemic and are now facing restrictive financial conditions. We may already be seeing some of that slowing as consumer spending was soft in both January and February, suggesting that there may be lower consumption growth in the first quarter than what we saw in the second half of last year. With less support from consumers, I expect GDP growth this year to be solid, but is lower than last year's strong 3.1%. Even with demand growth cooling, given the backdrop of solid supply, my baseline expectation is that further disinflation can be accomplished without a significant rise in unemployment. That said, the future is uncertain, and I am attentive to risks, both upside risks to my inflation outlook and downside risks to the outlook on economic activity. For upside risks, global developments such as the war in Europe and the Middle East could spark an increase in commodity prices or further disruptions in shipments. The tragic recent bridge collapse in Baltimore, right around the corner from where I live, and the effects on the port of Baltimore could also pose some risk, though it appears that shipping networks are adapting more quickly now. Additionally, consumption growth could turn out to be stronger than expected, particularly because of the wage gains we have seen across all income groups, but especially among the lowest earners who have an especially high propensity to consume out of income. Indeed, consumption was surprisingly strong last year and made solid contributions to GDP growth in the third and fourth quarters, though some of that strength may have been related to strong population growth, which more generally was likely disinflationary, as I have already explained. But there are also downside risks to economic activity. Measures of consumer credit delinquencies have been on the rise, which might point to more significant slowing of consumer spending than expected. And labor markets can sometimes deteriorate very quickly without much warning in closely watched spending data. The February employment report featured a rise in the unemployment rate, half of which can be accounted for by layoffs. I study, in fact, a range of layoff indicators, both in the official data and in measures based on information contained in publicly traded firms' earnings reports or Google searches, and I will certainly continue to watch a whole range of indicators very closely. Finally, let me discuss monetary policy. As I have noted, policy is currently restrictive, and my baseline expectation is that inflation will continue without a broad economic slowdown, though such an outcome is naturally not assured. In considering the appropriate path of monetary policy, I am guided by the FOMC's dual mandate of maximum employment and stable prices. After the March FOMC meeting, the committee said that it does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. After that meeting, we also published the Summary of Economic Projections, which summarizes the forecast of FOMC participants. Most FOMC participants expect that it will be appropriate to begin lowering the federal funds rate sometime this year. My own expectation is consistent with that. If disinflation and labor market conditions proceed as I am currently expecting, then it will be appropriate to start lowering the policy rate some this year. However, I will remain attentive to the totality of the data, and I would be prepared to change my economic and policy outlook if conditions change. If some of these upside risks or downside risks that I discussed before actually get realized. Thank you very much.
All right. Just a reminder, if you have a question that you'd like us to consider asking, now you can take a moment and pass those to the aisles, and we'll pick them up from you and potentially ask them. The governor has very graciously agreed to take some Q&A for the next 25 minutes or so. And we're extremely grateful for that. Thank you for those enlightening comments. The first question I wanted to ask was about employment. You talked a fair amount about inflation. We've seen stronger than expected growth in employment over the past year. And I'm wondering if you could talk about the causes and consequences of that, especially given the many headwinds that we're facing?
Yeah, thank you so much, Andrew, for that question. So you're right. In the past 2 years, since 2021, payroll growth has been very resilient. And it has been resilient even up until the last data we got for the month of March, of February. We're getting the March data actually this Friday. But if you look at the trend, what you see is on average, you had 600,000 jobs created in 2021, 355,000 jobs created per month the following year, 2022, 250,000 created in 2023. And now in the last 3 months, you have an average 265,000 created per month. So it's been cooling some. It's definitely been resilient. What are the causes? Well, one is the strong consumption, strong demand. The other one is the issue that there has been a lot of new business creation. So those new businesses are creating a lot of new jobs. So that's on the demand side. And as I said, demand has been resilient for labor, but it has been cooling some. The good thing is that that cooling has occurred without layoffs so far. As I said, there are some signs here and there of increased layoffs, but so far, it has not come at the cost of households and individuals losing their jobs and having to endure a lot of pain when they get laid off. So that's good news. So there has been some cooling on the demand side. On the other side, as I mentioned during my speech, there has been a whole lot of new labor supply coming in. And this has come mainly from two sources. It's been prime age workers, and in particular, prime age women, working a lot more than they used to at historic highs. And then the second one has been a lot of immigration. So these additional workers that are coming in and are helping precisely in services sectors where it is very badly needed, right? So if you think about it, immigrants account for 1/4 of all construction workers, 1/5 of all workers in leisure and hospitality. That helps to rebalance demand and supply. And that rebalancing has been very key because it means that wage starts moderating. So you don't have these wage pressures, which have contributed in particular to inflationary pressures in the services sector. So that rebalancing in the labor market is very helpful also for inflation, for bringing down inflation. And the rebalancing, the fact that you have growth in labor demand and an increase in labor supply has meant that you don't have a whole lot of unemployment either.
Fascinating. So, sort of inherent in everything we talk about, whether it's politics or economics, is this pandemic that we've just come out of. And we saw supply chain problems, among other challenges, during the pandemic. And I'm just wondering whether we have built resilience, or maybe the broader question is, what lessons have we learned in terms of economic and monetary policy from that experience that we're still reeling from?
So I think there is a lot that we learn in terms of how to deal with these supply chain disruptions. And as I said, part of that supply chain disruption that we saw was on the labor market. Many workers leaving the labor force in hordes. That's what we saw at the time. I think we've all tried to forget that very tragic period because that's what we do to cope with things, right? You try to leave it behind, but that's essentially what happened. A lot of those people, as I said, have come back. But there was also a lot of disruptions in terms of materials, in terms of machinery, in terms of all sorts of things that are needed to produce. I would say, as I said in my speech, right, we have largely healed from many of those disruptions, the supply chain disruptions and bottlenecks that I talked about. But we're not fully out of the woods, in part because there are geopolitical tensions, right? We see the problems in the Suez Canal and the problems around the Red Sea and the problems of basically shipments having to go all the way around Africa to be able to make it to Europe. Fortunately, only about 15% of trade, US trade goes through the Suez Canal, so that doesn't affect us very much. And the rising cost doesn't even compare at all. It's about a tenth of what it used to be back during the pandemic. But nonetheless, it's still there. Another example, in the Panama Canal with the El Nino, you had a drop in the water level, and there were many vessels that were not able to go through the Panama Canal. That once again causes ships to have to reroute, go through the West Coast instead of the East Coast, and it creates disruptions, it increases costs. But I think we have become somewhat better at navigating those situations. Another example, as I mentioned, the tragic events in the port of Baltimore, close to my house, are going to create potentially some problems. Yet, what we're hearing is ports in New Jersey, in North Carolina are stepping in and are saying, you know what, we're going to be able to take many of those shipments, many of which are cars, agricultural equipment, machinery, through our ports, and it will be okay. That's about 2% of shipments coming from abroad, so not as much. So I think you're right that we have learned to navigate these situations better. More broadly, there has been a lot more onshoring and friendshoring, right? So we're relying on suppliers that are closer to us. So that has happened already. Another thing that has happened is that also businesses are moving from just-in-time inventories to lean inventories, and have tried to manage that situation by having some level of inventories to count on. The last thing that has happened is businesses, once again, are now saying, well, we need to get to know much better, not only our first-tier suppliers, but our second, third-tier suppliers that we maybe did not know as well and didn't have as close a relationship with, to make sure that we have a backup. So I think businesses are navigating this new environment a lot better and are adapting, which means that maybe these inflationary pressures won't be as pronounced next time around, if there is a next time around.
Striking the volume of the portfolio, from consumer spending to weather patterns that affect water levels in the Panama Canal that fall under your purview.
That's what we know. We have to count on anything that comes our way. That's exactly right.
Changing topics just a little bit, what are the roles that entrepreneurs, that small business, that startups have played in both the pandemic and the post-pandemic economy?
Yeah, thank you for asking about that, Andrew. That has been quite remarkable this time around. During this recovery, we have seen many new businesses being created, many new business incorporations and entrepreneurship growing at rates that we had not seen in the past. So during this recovery, and for example, in the past 2 years, about 2 million jobs were created by these new businesses. About 150,000 jobs per month come from these new business incorporations. This is about 40% above what it used to be during the pre-pandemic time. So it's unprecedented. And this speaks to the dynamism of the US economy, right? The importance of these new businesses creating jobs, but they also tend to be more productive. And they also helped us with supply side disruptions. They're producing more, and they're helping us to address the issues of lack of materials, lack of equipment, lack of supply, which contributes obviously to inflation. Some of these came in part because there have been changes in work, lifestyle, but also business patterns. So when you think about the work side, right? Many people were working at home instead of going into the office. That meant that you needed businesses in the suburbs to attend to the demand that people working from home had. We all started ordering things online, and we needed things to be delivered to our house. So that's changes in lifestyle, and that required trucking, deliveries, new businesses, online businesses that were not there before. So there was a lot of these new incorporations came from that. But aside from changes in lifestyle, there have been also changes in the types of businesses that get created, for example, in IT, in more technical fields. So you have an increase in the demand for software, for hardware design, for data centers. And at the same time, we have all heard of these new developments in AI and different businesses trying to adapt AI to their business model. So there is definitely an increased demand, and new businesses are being created in precisely those fields as well.
Very interesting. Let me change course just a little bit and talk a little bit about the business, the operation of the Fed. You just had a meeting a couple of weeks ago to discuss monetary policy. Let me just very broadly ask you, what are those meetings like?
So I'll try to tell you what I can and then leave, right, not enter into the details. But as you know, the Fed is quite a consensus-driven organization. There has been a consensus, a long tradition at the Fed that you try to reach broad consensus on policy decisions. I'm actually a strong supporter of that. And I'm a strong supporter because it gives us credibility in front of the world, in front of the country. And we're representing and we're trying to do our very best to balance this dual mandate to represent all Americans. So if we get consensus, or at least broad consensus, that gives us some level of credibility. At the same time, I want to be sure that people know that it's not as if we arrive and rubber stamp and leave very quickly. That's not the way it goes. It's a long set of meetings for a number of days, 2 days, in which we engage in robust discussion and rigorous debate on all of these issues. And some of us may have different views on each of the issues that I talked about, right? The point of these meetings is that we may be challenged in our own thinking when we hear the views of others. And it helps us to develop our thinking, sometimes to change your thinking, or at least it forces you to think harder about why you still believe in your original view. And it forces us to make better decisions. The other thing it does is that, as I mentioned, right, we all have to represent all Americans. And the fact that we have different views and people from different backgrounds and diverse backgrounds helps us to make sure that those views are captured in our debates and are important in terms of understanding the realities across the country. So it forces us to make better decisions on behalf of the American public.
Now you're a brilliant and well-established economist, but you're relatively new to your position on the Fed. And I was just wondering if you could talk about the learning curve of becoming a new governor and what that learning process looked like, and the sort of preparation that you do in advance of these FOMC meetings.
Yeah, thank you for asking that. So as you know, you don't just walk into one of these jobs. You have to get confirmed through the US Senate. So that's the biggest preparation. When you're preparing for your hearings, when you're preparing for your confirmation, you meet with senators and you have to get to know the entire portfolio of the Fed. we all have different specializations. We all come with different skills. In my case, I'm an economist. I have a specialty in labor economics, but I have done also a substantial amount of work in terms of productivity and prices. So that's something I actually knew quite well, right? I was chief economist, as you mentioned, at the Department of Labor. I work closely with BLS, the Bureau of Labor Statistics, which produces the headline data on the CPI, on jobs, employment, layoffs, all of that. So that stuff I know inside out, right? The issue is putting it all together. And by the same token, I had worked at the World Bank. I understand these geopolitical forces. I understand how the US economy depends on forces outside of our borders. And that helps to inform our decision-making too in terms of monetary policy. So on the dual mandate, you have to kind of put it all together. We're very, very lucky because the staff at the Fed, and I'm talking about the staff both in Washington at the board, but I'm visiting the St. Louis Fed, and there's some staff here from the St. Louis Fed that I'm very grateful for. They also produce research in the respective reserve banks across the country, in the 12 reserve banks, that inform also our thinking. And I mentioned some of them here from the Richmond Fed, the New York Fed, right? The St. Louis Fed produces a lot of data. So that all helps to inform our thinking. But that's not the only thing that the Fed does. We work on supervision and regulation of banks and financial institutions, right? And we work on financial stability issues. So some of those issues certainly may be newer for some than others. They're experts on banking at the board, so those people feel very comfortable on that end, and then they have a steep learning curve on the dual mandate and our meetings and understanding the data. So there is a variety of expertise within the board, and some may have to learn more on one end and some of another. But what I have to say is that I have been just tremendously impressed with the staff at the Fed, which is very responsive, very committed, and just completely engaged in trying to make the very best decisions that we can make.
So we have some students in the room. Who's an undergraduate student here? Great. Okay. So we have a couple of questions maybe for our undergrad audience. But I think this is just a generally interesting question. What got you interested in the dismal science of economics?
Well, not so dismal after all, right? So interestingly, I'll tell you a little bit about my background. I am the daughter of Colombian immigrants, and I spent my childhood in Colombia, traveling the country. My parents worked, both of them, throughout the year, and during the summers, we would always travel to visit both sets of grandparents. I spent half the time with one set and half the time in another set. My maternal grandparents lived in one of the poorest areas of Colombia, what you would think of as West Virginia, maybe here in the US. So I saw all sorts of realities. That meant that growing up, I was exposed to seeing poverty, child labor, homelessness. I saw poor infrastructure. We got stuck. I remember one time when I was about 7 years old for 2 days in a row in a road due to a landslide. So those things stay with you when you're a child and you see all these things happening in front of you. Inequality at levels that you don't see in some other places, certainly not in the US. Unemployment, informal employment. So very poor and precarious conditions in terms of employment. Those things stick with you. So I had an interest in trying to understand why this was happening and what could be done about it. At the same time, when I was 15 years old, we moved back to the US, and I didn't speak much English at the time. So I decided to devote myself to to things that had universal languages, so math, sports, and music. And it turned out I wasn't so good at sports, so I played soccer and volleyball. I was okay in music. I played the violin, but I was very good at math. And so I decided, well, this is my thing, but I am interested in these issues. So economics seemed very fitting. As an undergrad, in fact, I studied both economics and political science. And then probably because of the math and because of the tools that economics seemed to offer, it seemed to be more fitting for me. And I decided to pursue it. And I decided to go and pursue a graduate degree, a PhD. I was very lucky. I studied at Berkeley, as you mentioned. 4 of my professors ended up winning a Nobel Prize soon after I left, including my dissertation advisor, George Akerlof, including Paul Romer, including Dan McFadden, who taught me econometrics, all those data analysis tools that I now use still in my job, and also Oliver Williamson. And I was extremely lucky because Berkeley had some incredible women faculty. Janet Yellen, Christina Romer, Laura Tyson, all ended up going to the Council of Economic Advisors. And it had such an impression on me to know that you could both be an academic and also work in the policy work and have an impact in the real world and make a difference in people's lives, that it convinced me that this was definitely for me.
Very interesting. A related question, I think this will be our last question, also maybe a question that applies particularly to students in the audience. What advice would you give, aside from switching your majors to political science, what advice would you give to students thinking about studying economics today?
So the first thing is, I think economics is a tremendously technical field. So I think honing in on your technical skills, becoming a real expert, will give you a lot of credibility. But by the same token, and this is something that I have found throughout my career, and I'm giving a talk tomorrow at the San Luis Fed in the Women in Economics Symposium. And this is something I'm going to share. I'm going to talk about how your personal background and your personal experience can be a really great complement to those technical skills, to the technical economic analysis that you use and the technical policy analysis that you use in our field. So I think the two together are really important, not forgetting where you come from or how you view the world or how that informs your view of the world. And it can bring a twist and a nuance and a way to see things that maybe others have not even thought of because they have not lived your own reality, right? And by the same token, they shouldn't forget because they have lived experiences that are really valuable to informing our decisions or how you do research, but also how you make policy decisions. So to me, honing in on those technical skills, becoming a real expert and very credible at what you do, but not forgetting that your own personal perspective can be incredibly valuable at informing very important decisions. At a more practical level, I would say once you have that credibility, it's really, really important to find good mentors, to find good networks, to find others who advocate for you. It's much nicer if somebody introduces you and says very nice things about you than if you have to go and do it for yourself, right? So, but you have to have that credibility in front of your mentors for them to be able to advocate for you. So I think mentoring, finding good mentors, good networks in your professional life is also very critical to make it through your career.
That's a good ways. Before we thank Governor Kugler, I just wanted to mention a couple of things. Please visit the Wiedenbaum Center website, wc.wusel.edu for more information on our spring events. There's also a flyer around and you can take a look and see what is on board. I want to especially highlight next Thursday, Hilke Shellman, an Emmy Award winning NYU journalism professor, will be here talking about AI and accountability and all the work that she's done in that space. On May 1st, we'll have a virtual conversation with our very own Steve Bazzari, former director of the Wiedenbaum Center and an economist, who will talk about his 42-year career here at WashU. And please mark your calendars for, in my unbiased opinion, one of the best events of the year, our annual Wiedenbaum Center reception on May 16th, where we will honor our Chancellor, Andrew Martin. And now, please join me in thanking Governor Adriana D. Kugler for these wonderful